I mean, like you mentioned, the PIDM protection, which StashAway Simple doesn't have, and it does seem to suggest that there's greater risk than putting it into FD. So is there a reason why StashAway doesn't have it?
There's a reason because no investments are PIDM insured. So even things like ASB are not PIDM insured. It's just that people make the connection because they know that their FDs are PIDM insured. So then they ask, is StashAway Simple PIDM insured? And if you look at the reason for PIDM, it's really to protect the financial system. The byproduct is that it's protecting you. Because if there was no insurance and there was a crisis, we would all run to the bank and there would be no more money in the bank. And there would be a lack of liquidity and the banking system would have a lot of credibility. So that's what the PIDM insurance is there to do. It's meant to serve two masters, the financial system and you. But when does it really often serve you? Like how, since the Asian financial crisis, there has not been any bank failures in Malaysia. So why protect yourself against a storm that will not come? And the money market fund that's investing your money is not it's not putting their money in small banks. It's actually putting your money in very, very large established banks. So if you want to argue both ways, I could say that you putting all your money into an FD in one bank, you are positing could go down. I could say that me investing for you and putting it in different banks, and if one of them goes down, there's many that remain, you'll be safer spreading your bets around. So both are academic points because a run on the bank will not happen, an Asian financial crisis will not happen. So really PIDM insurance is an insurance that you are very likely to not use. What you should be asking yourself is, what is the underlying investment of a money market fund? So a money market fund is invested in FDs. So it's a fund of FDs. So why so worried? It's just that naturally people fear what is new to them. And if you just dig a little deeper, there's actually nothing dodgy inside. It's just a fund of FDs. It could not be more boring than that. If you talk to any CFO in Malaysia, small and large companies, they're just like, yeah, we know what this is. It's just that agents have not spent a lot of time educating the market about this.
So in the event that StashAway, say, goes bankrupt, then what are the guarantees for your customers?
So that's a valid question. So any financial institution could go down, and what risk do you take putting your money with a financial institution? So the first thing is that we are licensed by the Securities Commission. So we are monitored, we are regulated, we operate at a very high operational and compliance level, undergo many types of audits many times a year. If there was any signs of impropriety, the regulator would catch it. And if, let's say, that aside, there was a business risk that we go under for whatever reason, we stop being able to raise funds and we run out of internal generated cash flow and we cannot sustain ourselves, we would wind up and we will return your investments to you at the market value. So you don't have to stand in line like a creditor because that's not how we are set up. We are set up using a system of trustees. So we have our balance sheet, which is separate to your investments, are actually on the trustees' care and so-called custody. So if we fail as a business, we would then liquidate all your money at that market rate. Say we had more than 1 billion. So we would, in a few days, to sell that, bring that back to Malaysia, and then attribute it back to you. It's not like being an investor in a bond and the company cannot pay you, and therefore you need to take a haircut and take 70% or 60% of the principal that you put down. So you're not taking quote unquote counterparty risk. And we also go so far as to only buy ETFs that do not use derivatives. We only have ETFs that actually hold the underlying asset. So if even the issuer of the ETFs, which is also unlikely to happen, goes down, you actually have ownership of those underlying assets. So those big ETF issuers like BlackRock and State Street and all that, if they go down, you would still not take counterparty risk. So you are protected at many, many, many layers. So let me just give you the TLDR. So firstly, we are regulated. Secondly, your money is held by trustees. And so you get back your investment if the company goes down. And thirdly, even the ETFs have ownership of the underlying shares and bonds and gold. So you don't have to worry about the ETF issuers going down as well. So is it a possibility? Yes. Is it a high possibility? No. We also just raised money last year in August because we survived tough times. Because we survived COVID, our investors saw that we were resilient, and actually it was a relatively easy fundraise because we were growing, we were doing very well, and we needed money to expand to new countries rather than just protect our position. So from a company's perspective, from an investment perspective, it's all very safe.
Before jumping into the investment, one final point. When people look at StashAway Simple, the thing that always jumps out is projected rate of 2.4%. So how do you get that number, and what kind of rate is StashAway taking itself?
So the rate that we get for StashAway Simple comes from the fund manager. So we ask the fund manager, 1 year from now, what is the rate likely to be? Then they give us a rate. And then because we are working with the fund manager as a corporate customer, representing many, many, many retail customers, they also give us a rebate. It's the same as buying in bulk. Like if you want to buy, you get a discount. So they give us a rebate, which we completely pass on to customers to round it up to 2.4 as well. So that's why we can represent that rate, is because every month we talk to the fund managers of this money market fund, and they give us a projection of where the market's going to be in 12 months. And the reason why they can give us a good forecast is, again, because it is a fund of FDs. So they can see how it's layered. They can see what's the weighted average maturity and the weighted average rate. So they can give us a very good projection. If you ask me to give you a projection on the 36% risk index portfolio, that's impossible because I don't know what individual ETFs will be doing. But for StashAway Simple, we wanted to represent a rate that is forward-looking so people can make an informed decision about where best to put their money. Because at the end of the day, it is still an investment, but it's an investment into many, many FDs. So we feel pretty good about the rate. And in Singapore, the rate has had to change because Singapore monetary policy is not the same as Malaysia. When they drop rates, the rates may drop as well. So with Malaysia, so far the rates have not dropped, and we're not forced to drop it yet. So in Singapore, we've dropped the rate twice, and we're still doing just fine because the FDs there are also at rates that are a little bit lower than what we are giving out on StashAway Simple there. So ultimately, we feel that for your spare cash, it's a pretty good place to be because there's very little risk to it at all. And the return that we project is also net of fees already. So don't worry about us chipping away at the fees and all that. What you see is what you get.
People always compare StashAway with Waheed and MyTheo. So how would you distinguish StashAway from these other guys?
As an investor, as a buyer, you can judge different platforms by comparing themselves to each other. And fees is just the first part. But then you have other things like the investment returns and the service level. So I think we are different because fundamentally we have ERA, and that differentiates us from others because they offer static portfolios that don't change. And for us, we think we can do it better. And actually, we have benchmarked the performance and the returns, and we are ahead by a very wide margin. So we outperform their investments by a long margin. So other non-financial, non-investment motivations could be things like, how is the app designed? Do they have good content? Do they put out good articles, good educational tools? And we do that through Academy inside the app. I would also argue, but this is subjective, that our app is more seamless and more intuitive. But that's subjective. Another thing I would say is that compared to Waheed, our investments are more global because Waheed is mostly local. So I actually think that global allocation is important. And then when we look at MyTheo, when we look at the ETF selection, when we put like to like next to each other, say, I'll take your emerging markets and I'll put it next to my ETF, which also is investing into emerging markets. Our ETF selection is just better. If you just do the homework and you drill down into their universe and our universe, we pick better ETFs, not just from a performance standpoint, but from a fees standpoint, from the track record, the consistent returns. So I have every confidence that I'm riding the right horse, but I guess it's really up to you.
One of the things I notice people always ask you is, are you in crypto? And you have said no because you haven't found any ETFs that are good for crypto. Do you think that's likely to change? Because there is a new Bitcoin ETF that was just found in the US by Scaramucci. So it seems as though more and more of these ETFs are popping up.
Yeah, so I think cryptos is a very interesting space, and it is something that we do believe from a diversification standpoint, people should have exposure to. But I do think that for us to actually get exposure to it should be a more meaningful percentage of our portfolio. And now, even if we were to include it, it would only be like something like 1% of our portfolio. So it's not that meaningful. And the ETFs, while they were just launched, it doesn't mean that they will last. ETFs have come and gone. And also the ETFs that track Bitcoin now are not doing a very good job because they are not tracking the price of ETFs. The ETFs are not tracking the price of Bitcoin accurately. For example, the Grayscale one offers it at a 30% discount to the actual spot price of ETFs. So my question to users is, if you want ETF, why don't you get it yourself and just manage it in a way where don't get too greedy, don't get too fearful, have a calm head. And for us to actually include crypto ETFs into our platform, a few things need to happen. Firstly, the asset class needs to be more mature, where we can actually backtest it through different economic regimes so that it could also be used in conjunction with ERA. If you just include it from a diversification point of view for fun, then that's no real value add for us, so we probably won't include it. And then another thing is that the ETF should really track the price of whatever coin it's trying to track, be it Bitcoin or Ethereum, much better than it is now. And those ETFs need to have much significant more size, and the fees should be very low for us to actually go into it. So I wouldn't hold my breath, but it doesn't mean you should hold your breath. You can actually go out there, get some coins for yourself, cryptos for yourself, and see how it goes. Because I do think from a diversification point of view, it's interesting. At least 1% of your investment portfolio, 5% of your investment portfolio into crypto, if you have the stomach for it, is my advice.
So we talked about raising funds earlier. I'd love to drill down a bit. So Series B, 11.8 million raised in July 2019, led by 8 Rose Venture. What was the purpose behind Series B? Because now you have Series C rate, which is 60 million, July 2020. So very fast.
Yeah. So Series B was actually done because we knew we wanted to expand internationally. At that time, we may not have known that we would have gone into 3 countries, but we also wanted to invest in Singapore, where we have a very commanding position, and in Malaysia, where we were just getting started. Actually, with Series C, it just so happened that the timing of us growing very quickly invited a lot of attention from the VCs, and we made the decision, rather the co-founding team made the decision that taking money would actually help us accelerate our growth. So it was not that we used up all the money from Series A and B, it was more about we can actually achieve more with the funds that we raised. So instead of just exploring new markets, we would actually make commitments, get the license, get the people on the ground, set themselves up in the way that Malaysia was set up, so that ultimately they could be engines of growth themselves. So that's what the money is for. I think there's also cycles, like when it comes to the VC world, like certain times money would be very hard to get, sometimes money will be easier to get. And I think the co-founding team felt that we're in a good place, we are receiving a lot of attention, let's just raise money. So yeah, it's all very, I want to say business as usual, but it's more like, it's just very clear-headed decision making rather than like, oh, we want to move into something crazy, we want to do something really, really different. It's all just about gradual expansion and also getting depth in different countries.
To what extent would your investors have a say over the way that StashAway runs? Because you have quite a few different VCs, like Series C was led by SquarePeg, which is a different VC. So it seems like quite a lot of interests are at play here.
Yeah, so SquarePeg, which is Australia's largest VC, also invested in us, and so did 8 Rose, Fidelity's VC, and also along with Series C, Burda Principal Investments, which is a German conglomerate, they are VC arm. So I think they all rally around the goal of the co-founders, which is to grow a digital wealth advisory company at scale. And the numbers show that, and they've been tracking our progress for a long time. And when these numbers keep getting better and better, they gain confidence. Ultimately, as financial investors, as opposed to a strategic investor, their goal is to make money. Their goal is to let the co-founders do what they feel is best, controlled by a very disciplined board, of course, but to let the co-founders lead the charge. And by doing that in a way that makes sense to them, basically the co-founders have been in the driver's seat, so to speak. So because of that, the direction has always been very clear. We've never deviated from our goal of empowering people to build wealth for the long term. There's not been any side projects that didn't make sense or vocal board members or anything, nothing of the sort. They're also very mature VCs. So they have been through many, many companies, and they've seen different things in different countries. They've gone through crises. So there's a very mature board. They want to set us up for success where it enables them to make a huge return, something like 10x of their investments. Otherwise, wouldn't justify the investment. So I think they're giving us a very good chance of doing that. And as someone who has worked here for about 2.5 years, the direction has always been the same. So I have faith that it will continue.
It sounds as though, given everything you're saying, that you have a very positive outlook in terms of the global market. Would that be a fair assessment to make?
Definitely now in March of 2021 versus last year, I think investing is never easy, but you should not let timing be an issue, because as long as you take the long view and as long as you dollar cost average, you'll be fine. So a lot of the risk factors that were there last year are not here. And even if there are risk factors, there are less. So what I mean by that is there's no Trump anymore for that global instability. There's no more COVID for that health-led economic crisis. So the only thing that's putting markets at risk now is the speed at which we come out of the COVID lockdown and the economies reopen, and also for the financial markets to readjust to normal growth again, because the US Treasury has done a lot to prop up markets in bad times. And it's proven to be very effective. So it needs at some point to actually be in control of the current situation. So it gives the markets a very good chance of doing well and recovering.
What do you think the rich know that the poor should know?
I think what the rich know, and therefore it's something that they see, is that they have more options to invest their money, and more money is being thrown at them and given to them for them to use, because they are such good customers in the eyes of the banks, that they get faster accelerants to reaching wealth. So for example, if you're a wealthy individual and you make $1 million a year, you pay a certain amount of income tax and you follow the same schedule as someone else. You follow the same schedule as someone else. But then the thing that sets you apart is investing. So rich people invest in a way where they actually get very little taxed in terms of capital gains, because in Malaysia, there's no capital gains. So poor people really need to think about getting into a mode where they can actually invest. Whereas rich people actually get a lot of options to invest and actually see more options to invest and actually get given more money to invest. And because of that, they race ahead and it's very hard to catch up. But it's not too late to start. It's just, how do you really get ahead?
Well, thank you so much, Wai Ken, for your time. So these are the final questions I always ask all my interviewees. The first one is, do you feel like you have found your why?
I hope so. My why seems to change. I think that is something that is perfectly natural. Back then, my why was do it for passion, whereas now I do things for enjoyment and to be true to myself and to be in the moment. So I'm driven by that ability to be who I am and do what I'm good at in the company that I am at now. I think that fuels me, and your why can change. So back then I wasn't married, now I am. And if I have a family, that will change in the future, the why will change as well. So be flexible, be adaptable. And to me, my why is I really get to be myself. I really get to exercise a skill that I enjoy and be in a relatively good position where I can affect change.
What kind of legacy would you want to leave behind?
I honestly don't know, but what I do know is that since I've started working and getting involved in business, I've always wanted to be in a position of leadership. I think it's because whenever I look at my situation, there are more and more things that I want to affect, and you can only affect them in positions of leadership. I like to think that I get to be a part of businesses and platforms and opportunities that mean something to people and myself. And when I am no longer there, then they will speak of me kindly. I think that's all I really want. That day I was hosting some friends at our office, which we just moved into. And I said that it's very likely that StashAway will be in this location and in this office beyond me. I will move on, because even in life, everyone else moves on. And then I was talking to my wife and I said, like, even with Batman, there's new Batman. And the new Batman will not ask the old Batman what he did with the role or whatever. So there will always be a new Batman. There will always be a new leader. And I just want to be spoken well of, like, oh, okay, the George Clooney Batman was pretty good. The Christian Bale Batman was pretty good. And that's all I want, because by then I would have been gone and on to do different things or not around. So it's fine. So as long as I leave behind a platform and a position in a business in a decent shape, that's all I want as my legacy.
What do you think are the most important qualities of a successful person?
I think each person will have a different quality. I think my qualities are to have perseverance, to have resourcefulness, and to be fun to work with. I think those things are what keeps me going. And time again, I rely on these things to push through different challenges, different issues that come up, problem solving. But at every time, if I ask myself, am I having fun? Am I liking what I do? That is really, really important to me. So as long as you can persevere, you can be resourceful, and you can have fun, I don't think you need a lot else.
And how can people follow you, find out what you're doing, learn more about StashAway, sign up?
So pick your poison. I like to be on as many platforms as possible. So you can find me on LinkedIn. I'm also on Clubhouse. Just type in my name, Wai Ken, and you'll find me. I also do StashAway's Academy events almost every week. So on Wednesdays, if you want to hear me talk about specifically money, you can follow me as well. But if you want to sign up to StashAway and get a promo for your listeners, you can go to stashaway.my/Wai Ken. That's WAIKEN. And then you can actually get 6 months, no management fees.